Good day, fellow investors. About 2 weeks ago I made this video discussing 10 stocks, and one of the stocks that I said I'll dig deeper because it was interesting from a risk-reward perspective is Warner Bros. Discovery, the spin-off. So in this video we'll discuss the situation, the investment opportunity which is there, so you have to see how the risk and reward fit your portfolio. So let's start. So Warner Bros. Discovery, the merger and spin-off from at&T. If you look at what's going on, you can see here how over the last months the stock went from 25 to the current 14. That is a big decrease. And when it comes to investing, especially value investing, you can find a lot of value in these spin-offs. What's going on with this spin-off? So Warner Bros. Discovery spin-off, at&T shareholders got 71% of this company. And what are at&T shareholders investing for? They're investing for the at&T dividend. Then they get something that is uncertain, and what happens? They simply dump it in the market. So they dump it because they see it as a dividend. It doesn't pay a dividend. They are dividend investors, and you have so much selling pressure that 50% down is not an issue. And this is something that often happens with spin-offs. For example, another spin-off, Chemours from DuPont, I think. So look at this, spun off at 20 in 2015, and sometimes it's also about timing. If you spin off in a bad market, the new shareholders don't know what to do with it, and you can see this. So down from 20 to 4, only to rebound to 57 when things got better. So this is really incredible, but always there could be irrationality and value because these shareholders that get it sell it for no reason that's rational. And therefore, spin-offs are one of the places to look for value. So we have to see now whether this is a bargain value opportunity. Keep in mind the numbers here, the market cap for valuation 35 billion. And let's now look at the business. For now, the numbers are not yet clear and combined, but we have this presentation that explains what's been going on here. So the merger of at&T Warner Media with Discovery. They expect to generate 3 billion per year in synergy that can be reinvested into content. So all these companies are constantly reinvesting into content, and that's also an uncertainty. You're not paying a dividend, you are reinvesting into content. But there is more. When you look at the transaction summary, okay, at&T shareholders get from the new company, but also at&T had debt issues, and they dumped 43 billion of debt into the new company, plus 15 billion of Discovery's debt. That is 58 billion of debt, and when you add other liabilities, that's more than 60 billion quickly compared to a market cap of 35 billion. So more than double the market cap is just debt. That's something to keep in mind, and this is of course what they do. You probably know all of these things, use them, enjoy them. So a lot of content there for sure, but let's go to the financial highlights. So revenue, greater scale, 52 billion expected revenue, and already in 2023 expected 14 billion of EBITDA. Normal company EBIT, price to EBITDA is 10, that's 140 billion if things get to normal stability. That's potential 5x. They target increase in DTC revenues already and then growth there as they invest more in content, significant synergies, and we'll see later about the robust free cash flow. So here we go, they will use the free cash flow to reduce debt and lower it from 5x now to 3x, and then stabilize it to 2.5 to 3 to keep the investment grade. Of course, they will do that by really getting higher revenues, so 15 billion increase there in revenues with a 60% free cash flow conversion from EBITDA. 16%, that's 8 billion in free cash flows. And if they reach those 8 billion in free cash flows per year, start lowering that, creating value, that is a free cash flow yield of, what is this, 20% here. That is insane, and that won't last for long. So this could quickly go to 80 billion at least, which means that it is double and back to where it was when it spun off. So what is my thinking here? I think that from a risk-reward perspective, it looks positive. We have a 2x just when things normalize. We have a potential 5x if they can really lower the debt, increase the growth, and create a strong, powerful company out of the content they have. So that is huge potential. 2x to 5x potential. But when it comes to investing, this is something I really focus on. 60 billion of debt, which creates high uncertainty, which makes this also risky. Because if they don't manage to work on their plans, if there are issues like there always are, then we have a pickle. So it won't get crazy because they can always sell some assets, they can do this, they can do this, but it can always get ugly from an investment perspective and stay where it is, or even go 20, 30, 40% lower and then be ugly, then have issues than this, just as a normal business has. So you have to be ready for this. And the risk and reward, let's say 50% down versus 2x or 5x in the best situation, is positive for an investment, but I wouldn't put 35% of my portfolio in it. Maybe it is interesting for those that have portfolios between 20 and 30 positions, and then, okay, this risk reward is positive, let's see how it goes, let's follow it, let's put 3% of my money in it. If it goes down and things remain from the same risk reward, then you increase it to 5, you will likely over time do okay. Maybe they start paying a dividend from those free cash flows in 1, 2, 3 years, and then you have a great dividend player in your portfolio that you can then reinvest. So that would be the strategy, and that is what makes this a spin-off buy from a value perspective. But you have to keep in mind also the risk, and therefore keep in mind the portfolio exposure. I am, when it comes to investing, a very concentrated person. I like to put my money in a few baskets and then watch the freaking baskets. So I'm not interested in this risk reward because I still think I have better. So I'm not going to invest, but if you want, we can make a video every 6 months. Let me know in the comments, and just follow this as our YouTube large, let's say, risky portfolio. We can start thinking about that. So let's say if I have to manage 30 positions on YouTube, I would put now 3% in WBD. So that's one idea, and then I'll put it in the link in the description below, and I'll add the sheet to my Excel table. That's free from download in the link in the description below. Smash that like button if you enjoyed it. Check out what I do, and I'll see you in the next video.